Real estate syndications have gotten a pretty bad rap over the last few years with some really high-profile failures and a lot of negative press. But even though the bad actors in this industry tend to make most of the headlines, getting involved with these deals can be one of the best ways to get exposure to commercial real estate without having to go through the process of finding properties to invest in and managing those assets. So in this video, I want to walk through both the positives and the negatives of investing as a passive limited partner in real estate syndications and some of the key things to look out for if you decide to go this route. So to step back and start by defining what a real estate syndication is, this is essentially just a partnership between equity investors to own and operate commercial property. And in these types of deals, there's an active general partner that manages the investment along with multiple limited partners that only contribute capital. And one of the biggest things that makes these deals so attractive to investors that don't have the capacity to actively manage their own deals is that these are truly hands-off investments that don't require your time. As a passive limited partner, you won't be the one responsible for collecting rent from tenants, negotiating leases, managing construction projects, or finding these opportunities in the first place, which can make these great options for busy professionals who want exposure to this asset class without any additional work. What's also great about these types of deals is that even when you're investing as a passive limited partner, you still get all the tax benefits of direct ownership in commercial real estate, which can be a huge benefit for investors with high annual incomes. And in a lot of cases, due to things like bonus depreciation and interest expense deductions, passive investors will actually show a loss at the end of the year for tax purposes, even if they've received operating cash flow distributions throughout the year, which can create tax-deferred income for investors and operating losses that they can carry forward to future years. And beyond just the tax benefits and how passive these investments are, where real estate syndications really shine is that these deals allow you to invest in one specific property rather than in an entire real estate operating company, which gives you a lot more control over what's in your portfolio. A lot of people look to publicly traded REIT stock to get exposure to commercial real estate, which typically involves buying shares of a publicly traded company that owns hundreds or even thousands of properties across multiple different markets and sometimes even multiple different product types. But when you invest in a real estate syndication directly, you get to see each individual property that you would be investing in, which gives you the opportunity to analyze each individual market, each individual business plan, and the projected returns on each investment. And this also means that you can double down on a specific city or a specific property type that you believe in most. So if you wanted to get exposure to industrial development in South Florida, for example, this is something you could directly seek out through investing in individual deals. Now, with all of those things said, even though there are a lot of upsides of investing in these types of deals, there are also some pretty significant downsides to be aware of if you do decide to go this route. And the first thing that's really difficult to unravel once you're in it is that once you've made a handful of passive investments, your own personal tax situation can start to get pretty complex. Most real estate syndications in the US are structured as pass-through entities for tax purposes, meaning that each investor is subject to their own individual tax rates on the proportion of income and capital gains they earn. And this also means that if the properties that you've invested in are located in different areas of the country, you may also need to file tax returns in each of those states. And this means that if you live in California, for example, but you invest in properties located in Washington, Oregon, and Colorado, you might need to file tax returns in all of those states. And if you're working with a CPA that charges on a per return basis, the costs associated with these filings can start to add up quickly. What can also be surprising for newer passive investors is that most real estate partnerships won't have their final tax forms ready for investors until March or even early April in some cases, which means that you'll often need to file an extension on your personal tax return. And speaking of tax implications, another downside of investing in these deals is that as a passive limited partner, you also don't have control over the timing of major decisions related to the property you invest in, which can have huge impacts on your taxable income each year and the cash flow you can generate. And when a property that you've invested in also ends up being sold, this also means that the cash flow distributions that you may have gotten used to on a monthly or quarterly basis are no longer going to be available. And if you were relying on that income to pay for regular living expenses, this can add a lot of uncertainty to your investment portfolio. The general partner on a syndication deal also has full control over decisions related to things like major capital expenditures, refinance timing, and even the amounts of operating cash flow distributions made to investors. So even if a property doesn't end up being sold outright, you could still see your cash flow fluctuate unexpectedly. Now, the last thing I want to talk about that tends to trip people up about these investments, especially early career professionals that are just getting started, is that investment minimums can be extremely high on these deals, and there are often income or net worth requirements just to get your foot in the door. Investment minimums on real estate syndications typically range anywhere from about $50,000 to $100,000 or more, which can take a lot of time to save up for depending on your income. In a lot of cases, you'll also need to qualify as what's referred to by the SEC as an accredited investor to get involved with certain opportunities, which comes with its own set of requirements that are also difficult to meet. Accredited investors need to have a net worth of at least $1 million, excluding their primary residence, or they need to have an annual income of at least $200,000 a year as an individual or $300,000 a year as a married couple for the last 2 years, with the expectation that they'll continue to earn that amount going forward. Now, these requirements are ultimately a good thing, and they're put in place by the SEC to make sure that only investors who can afford to lose the capital they've committed are able to get involved in these types of private offerings, but this is something to be aware of if you're looking to invest in these deals. Ultimately, real estate syndications can be a great way to get exposure to commercial real estate without having to do the heavy lifting yourself, and the tax benefits and the ability to invest in specific properties and geographic markets can be really attractive, but the lack of control, the tax complications, and the high barriers to entry are all things you need to think about before making this part of your investment strategy. And if you want to learn more about the process of analyzing passive real estate investment opportunities, or you want to build the technical skills you'll need to work at a company that raises equity from third-party investors, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on syndications or fund structures, make sure to hit the like button and let me know. And let me know in the comments if you've invested in real estate syndications in the past, and if so, what that experience has been like for you. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.